Welcome back to Factful Finance. Today we're diving into a headline that might make you sit up straight. The stock market just lost $4 trillion in value. That's right, 4 trillions. With all the turbulence, you might be wondering, what does this mean for my mortgage, for my loans? You're not alone in your concern. Let's break it down and make sure you understand how this massive market shift can affect you, whether you're paying off a mortgage or managing personal loans. First, let's put this $4 trillion loss into perspective. The S&P 500, the benchmark for large-cap U.S. stocks, has dropped more than 8% from its all-time high just a few weeks ago. And for tech stocks like Tesla, they're down over $125 billion in just a day. The catalyst? Growing uncertainty around President Trump's trade policies, especially tariffs with major trading partners like China, Canada, and Mexico. Now you may be wondering, why should I care about the stock market's wild ride? I'm just focused on paying down my mortgage. Well, here's where it gets relevant. First, interest rates. When the stock market takes a hit like this, the Federal Reserve may decide to step in to stabilize things, sometimes by cutting interest rates. While this sounds like good news for your mortgage, it's important to understand the timing. When interest rates drop, mortgage rates tend to follow, meaning it could be a golden opportunity to refinance or lock in a lower rate. But hold your horses. It's also important to track inflation, which may rise as a side effect of tariffs and economic uncertainty. Inflation can ultimately push interest rates back up. Second, economic uncertainty is a huge factor right now. As the market dips, people start pulling back on spending, businesses cut back on hiring, and some industries, like Delta Airlines, are already lowering profit forecasts. If this trend continues, we could be looking at higher unemployment rates, lower wage growth, and ultimately less buying power. So what does this mean for your loans? If you're carrying high-interest debt, such as credit cards or personal loans, rising economic pressures might cause lenders to raise rates on new loans or variable rate loans. This means higher monthly payments for you. Tip: if you're in this situation, consider accelerating your debt repayment plan before rates climb higher. But here's some good news. There are always strategies to keep moving forward. Invest in stability. Defensive sectors like utilities and government bonds tend to hold up better during market downturns. So, if you're managing investments, you might want to look at diversifying into these areas. More importantly, keeping your eye on the long-term trends can help you avoid knee-jerk financial decisions that could hurt in the future. Let's talk about real-world application. Take Amelia, for example. Amelia has a fixed-rate mortgage, but she's been eyeing refinancing options for the past few months. With the stock market drop, she decides to wait for the Fed's next move. Sure enough, the Fed cuts rates by half a point. Amelia locks in a lower mortgage rate, saving her thousands over the life of her loan. On the other hand, Liam, who has a variable rate loan, is a bit more concerned. As tariffs cause inflation to rise, his lender hikes his rate, raising his monthly payments. But Liam's been proactive. He paid down his loan balance aggressively over the last few months, so even with the increase, he's still ahead of the game. These are the types of strategies that can make a world of difference when the market moves unexpectedly. The bottom line? While a $4 trillion loss is a major shakeup, it doesn't have to shake up your finances. Stay informed, stay ahead, and be strategic with how you manage your mortgage and loans during times of uncertainty. What do you think? How are you preparing for these market shifts? Drop your thoughts in the comments. I respond to as many as I can. And hey, if you found this breakdown helpful, don't forget to hit that like button. Want more finance insights? Stay tuned, because what's coming next could be the key to taking your financial strategy to the next level. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Click on the next video on screen to learn how you can protect your wealth in uncertain times. Trust me, you don't want to miss it.